All right, all right. Good afternoon, you magnificent melon heads. Happy Friday, everybody. It is my absolutely favorite time of the week. It's time for my Friday afternoon live stream. Hello, Mom. Hello, Dad. I love you guys. I hope you are well. Hi, everybody out at home. Good news. Good news, everyone. Our leaders have announced a massive global initiative, cooperative, where all the countries of the world are going to pool their assets. We are going to massively ramp up energy production, build new fertilizer plants, and we are going to act as one just in time to solve this humanitarian crisis that is emerging, the global food shortage. They're going to get out in front of it, and they're going to solve this problem before it blows up in our face. That's what I would be telling you if we had leaders who actually didn't have their head straight up there. No, that is not happening. That is not what our leaders are doing. No, they are virtue signaling. They are still trying to shut down pipelines. They're still worried about sustainable carbon emission free fertilizers and organic farming and whatever else we can do to solve whatever woke issue of the day is en vogue. We're still arguing about who gets to use the ladies' room. We're not talking about how are we going to feed 7.5 billion people when global crop yields are looking to decline. Nope, we are just going to march face first right into a global famine. So our leaders appear to be either mentally or emotionally or both incapable of dealing with this issue. Folks, be ready. Be ready for this, all right? If you've been following this channel for a while, then you've seen this coming. I've been talking about a food shortage since as early as October, that this fertilizer story was going to happen. And again, folks, the war in Eastern Europe was not the primary thesis of that food shortage. It was the fertilizer thing. The fertilizer thing still hasn't hit food supplies. It hasn't even started yet, okay? We already have riots in at least two countries, Sri Lanka and Peru, over food shortages, all right? That has nothing to do with the fertilizer story. That's just your standard inflation that we're seeing in everything. That's a little bit of the disruption from what's going on in Eastern Europe. The big story, the fertilizer story, that has not even started yet. All right? I cannot drive that home enough. Take advantage of this time, okay? Learn some kind of basic skill that will make you more useful during a food shortage, something you can barter with and negotiate with, all right? Figure out how to economically produce your own food. Don't go out and throw thousands of dollars at starting a hobby garden, all right? You're just wasting resources if you do that, all right? But read something, learn something, start developing those skills. I went out and bought a chicken coop. My basement is full of chickens right now. Maybe don't do what I did. But, you know, I saw what was going on with the price of eggs. I saw some of the videos that Chris Taylor over at Financial Fitness was doing about that bird flu. And, man, shout out to Chris Taylor. I've mentioned this before. He was so way out in front of that story. I mean, he was talking about this avian flu when it was still just in Israel. It hadn't even happened in any other country. It was just affecting Israel, and he was all over that story. And one by one, other countries have detected it. And now we're killing tens of millions of chickens here in the States. You know, that's hundreds of millions of eggs a week of production are being wiped out right now. So eggs, chicken meat, it's all going to get more expensive. So, you know, thanks to Chris and him covering that story, I was like, you know what? A chicken coop is something I can do with a minimal investment. I spent a couple of $1,000s on a coop and a run. I overspent. I had to get something that looked nice because Gigi wanted to make sure I didn't get this big, ugly mess. If she had let me, I would have gone and bought somebody's like old, decrepit kids' playhouse or jungle gym, and I would have converted that into a chicken coop. But she wanted something that looked nice when she looked out into the backyard, so I spent a little bit of money on a nice chicken coop. So my ladies, my hens are going to have very lavish accommodations, really, really ritzy, upscale chicken housing, you know, top notch. But right now they're just down in my basement making noise and kicking up dust. Nobody warned me how much dust chickens kick up, especially when they're like adolescent chicks. So my poker table's covered in dust. I'm going to have to clean that up this weekend. But the birds will be going in the coop soon. So I made a little investment and some production, some food production. And if the price of eggs do what I think they're going to do, the payback for that chicken coop and all that investment is going to be very short. So that's my story. That's how I am partially preparing myself for the food shortage. I'm not going to go out and turn myself into Old McDonald overnight. It's not going to happen, but I'm doing a little bit now to learn a little bit. I'm also stockpiling my precious metals and my cryptocurrency. And I see Mr. Dumb Money Media. Hello, sir. The king of money is in the super chats. Thank you very much, sir, for your support of the channel. I hope you are well. He says, what's up, man? My move to Arizona is finished. Congratulations on reaching escape velocity from the People's Republic of California. And I'm never going back to Cali. I do not blame you. I made a similar move. I escaped from the People's Republic of New Jersey, where I grew up, and I am now living in free America, a.k.a. Pennsylvania, and I have not looked back, although I miss my friends and family from back home. But I am on the right side of the border now. He says, my internet's still a little wonky after being set up, but I should be able to start editing again, so stay tuned. All right, brother, stay with it. Stick with it, man. YouTube, it consumes a lot of time. Trust me, I know, but I love it. It's a great time. I love doing this. I love interacting with you guys. I like doing the research. And I got my man above my pay grade. Hello, sir. Welcome back to the channel. It's another YouTuber. Got Dumb Money Media and above my pay grade today. Both YouTubers. Check out those channels, guys. And he says, respect my adjectives. They're awesome and jacked. All right. Well, my adverbs are, I don't know, what are adverbs? Adverbs have to end in ly. I don't know. We're getting all in this, what is that, part of speech? Is that the term? Noun, adjective, adverb, pronouns, all that stuff? All right, well, you are awesome and jacked, APG. Congratulations on your awesomeness and jackedness. Jackedness? That's what we'll call it. All righty. So thank you, guys. I appreciate your support of the channel with those super chats very much. With that, I think it's time we're going to shrink my big fat melon of a head, and we're going to just real quick visit at markets. I got a lot of windows open today. There's a lot going on, and I want to talk about next week because I think it could be something big happening next week. I don't know. I get a little excited sometimes. Maybe it's just me. Maybe it's hyperbole. I'll get into that. But right now, the S&P is down not even 1 point, just barely negative for the day. The Dow is still up 200 at 0.5% for the day. The NASDAQ way down over 1% at minus 141. And this actually, believe it or not, looks like a functioning market to me. The Dow should be up. People should be investing in basics and industrials and, you know, the production of stuff and not paying ridiculous multiples for high-flying tech stocks. So I actually like to see the Dow up and the NASDAQ down. That's at least a little reasonable. I mean, they should all be down. They're all overvalued. But if one is going to be up, it should be the Dow, and the NASDAQ should be in the red. We've got oil is at 97.86, gold 19.46, and silver just under 25. The 10-year bond, oh boy, 2.71, heading up there. Real quick, let's revisit. There it is. The MMMRI, or the M cubed, is at 211. Well into extreme risk territory now. We are now higher than we were for the Powell pivot, higher than we were for the global financial crisis, and higher than we were for the dot-com bubble. We're coming up on where we were for the bond market massacre in 94. I think we were like 216 for the bond market massacre, and then Black Monday 1987, we were at 230. So, man, we are in super, super risky territory here. Let's take a look at the chart of charts, 2.71 on the 10-year Treasury. And once again, folks, I have to eat some crow because I sat here for months and I told you guys 2.2% was where something was going to break, right? I said it over and over and over again. Well, 2.2 came and went, didn't it? And we are just way, way higher than that now. If you would have asked me a few months ago, even 2 months ago, do I think we'll ever reach 2.7%? I would have told you no, I don't think we'll get that high. So we're up there. I mean, and zooming in here, these are 1 month candles. If you look, we're now even above the 200-day moving average. I'm sorry, this is the 200-month moving average for the 10-year Treasury, and we are above that now and still heading higher at the high of the day right now. I don't know how high this can go. It keeps defying my expectations in heading higher. But remember, with the Powell pivot, we actually went above and we stayed above for quite a while, stayed above that trend line before we eventually broke back down below. We're still heading higher here, folks. So, you know, I can't tell you how high this is going to go. All I can tell you is we've already gone higher than it took to break something in previous events. All right. Now, what could be the straw that breaks the camel's back? I have one possible theory right now. So with that, we are going to get into this. I hope you guys had a chance to see the video that I put out this morning. If you haven't, I put a link down in the description. I did this video about the everything squeeze, it was called. And I wrote a companion article to go into this. The channel was a little quiet this week. There was 2 days that I didn't do any videos. I didn't get anything up on Thursday, nothing up on Wednesday, nothing up Tuesday night. I just did my Tuesday morning live stream. Because as I started digging into this, I caught wind earlier this week when I saw JP Morgan put out this note that they were reviewing their commodities exposure. And that rang some alarm bells. And by the way, everything I'm going to talk about, I have written a companion article for this video over at Brian Zarb's website, The Technical Chartist. I've also put a link to that in the description down below. So when the stream is over, if you want to check out that video and the companion article, you can check those out. There are 13 different articles and sources referenced in this article, all different headlines going back in the last month or so about banks making some kind of warning or taking some kind of step to protect themselves and insulate themselves from counterparty risk in commodities markets. All right. And I mean, it's not just one bank. JP Morgan appeared a lot, but there is a lot going on in this commodity space right now. And real quick, I just want to say, Cheeseburger, thank you, sir. I appreciate the super chat. He says, why did Russia back down on gold? By the way, my adjectives are sad and pathetic. You guys are good. All right, sad and pathetic Cheeseburger, Mr. Matt. Thank you for support of the channel. We'll talk more in depth about this. Russia yesterday abandoned their bid, their 5,000 ruble per gram bid on gold. My guess why is that they did it because the gold price, the ruble price, had gone so high above the COMEX price that Russia realized they could buy up the gold for cheaper. So they had accomplished the mission that they set out on, which was to shore up the decline in the ruble, which they were able to do that very abruptly. And then when the ruble price exceeded the COMEX price, they just said, you know what, we're not going to overpay for gold. And they abandoned the bid. We'll see if they bring it back. I'm not going to lie, I felt a little disappointed to see it get abandoned. Maybe that's wrong of me or selfish of me. There it is. That was my first feeling. It was disappointment when I saw that. So there you have it. Then I have Mike Robin, a.k.a. Mike Binder. I always call you Mike Robin. Thank you, brother. Appreciate the super chat. He says, so they want to cancel student loans, but mortgage rates are 5%. How about rolling over all the commercial real estate that you showed a while back? Yeah, why are we forgiving student loan debt, not mortgage debt? How about we forgive small business debt? Why do kids who go get a degree in underwater basket weaving, why do they get their debt forgiving? But the guy who didn't go to college, he took out a loan to start a small business. Why doesn't he get his debt forgiven? What's the difference? They both borrowed money with a promise to pay it back. I don't get it, Mike. I really don't. And commercial real estate, keep your eye on commercial real estate. That's another issue. Funny you should mention this. Another issue that's out there. There's a lot of commercial real estate debt right now in the U.S. economy in particular that is backed up by commercial real estate that is not worth anywhere near the amount of debt that was taken out against it. And I don't know when that is going to come to a head, but it will be coming to a head. All right, thank you guys very much. I really appreciate the super chats and the support of the channel and your comments. And Mike, for everything, all the information you send me and the links. Thanks again, brother. I really appreciate all that stuff that you do for the channel. Now, back to the everything squeeze. So what happened this week? JP Morgan announced that they were doing this review of their commodity exposure. And that made me start to look into what was going on in the commodity space. Because next week we've got CPI, next week we've got bank earnings. All right. And I know there's a lot of channels out there that have been saying banks, buy banks, buy banks. And I get that. The prevailing wisdom or the conventional wisdom is that banks make a lot of money in a rising interest rate environment, right? And boy, are interest rates rising, right? I mean, look at this 10-year chart here. Just look at that. Yeah, interest rates, they are rising. So I get that conventional wisdom that banks should make more money because banks make loans and they charge interest, right? If interest rates are going up, banks make more money. That makes sense. But the more I've looked into this, It's not the full picture. Banks make money by charging more interest than they pay out for their deposits, right? When you put money in the bank, you earn interest. And then banks make loans and they earn more interest than they're paying you. The difference is what the banks earn. Well, right now the yield curve is inverted. All right. And what the banks do is they borrow short term, they pay short term interest, and they lend long term. So they earn long term interest. Well, right now, short term is higher than long term. The banks aren't lending at a loss, they add margins. But suffice it to say, an inverted yield curve is stressing bank earnings. It's stressing their margins. Their margins are being compressed by the inverted yield curve. Their short-term borrowing costs are higher. Their long-term earnings are lower. So that's one thing. I went looking at banks because I had already had suspicion between that and the Chinese developer bonds defaulting and now Russian bonds defaulting. I had suspicion that there was something wrong in the banks. And I went and I started looking, and I didn't find what I was looking for. I was looking for bond defaults. What I found was counterparty risk in commodities. And the more I started looking there, the more I found. And it took me 2.5 days to get that article written and that video done, because the more I looked, the more I found. I just kept finding more and more and more. And it ties in all these stories. It ties in oil. It ties in natural gas. It ties in gold and silver and the big shorts at the banks. It ties in this Chinese nickel fiasco that happened. And even last night, I'm talking with Brian Zarb, who runs the technicalchartist.com, the website where the article was published. And as Brian and I are reviewing the article right before publishing, another story hits the tape about Trafigura yanking all the zinc out of the LME vaults. Well, now we're looking at potentially a short squeeze in zinc. So there's another commodity story going on there. I'm like, Brian, we can't publish yet. I have to put another paragraph and another citation into this article. And then I had to record another segment for the video. I mean, it just, the more time I spent on this project, it was never ending. I had to finally publish it. I had to just say, that's enough. This story is happening before my very eyes. Let me publish before it happens. And then just today, after I published it, I saw this article came out. This is in Bloomberg. Let me make sure you guys can see. You can. LME risks more squeezes as metal stockpiles hit lowest in decades. Freely available inventories hit the lowest since 1997. Zinc inventories have plunged since Trafigura books large volumes. And this is all about metals are being drained. These are base metals here, okay? I'm not talking about precious metals, at least not yet. These are base metals: aluminum, zinc, tin, lead, nickel, right? Copper, base metals. And there's something else that I saw in here. I wanted to talk about this because there was a mention about copper. Not bookmark bar. I said Control F. Here, I saw this one. This is a quote from Goldman Sachs, who they said that copper is sleepwalking towards a stock out while freely available zinc inventory shrank by more than 60% in 3 weeks. So when they say sleepwalking towards a stock out, that means the LME vaults, their warehouses, they're running out of copper, but prices aren't going up. And that fits right into the story, because what's going on, and I talk about this in much bigger detail in this video. Go check out that video that I put out this morning. The banks right now are worried that the commodity traders cannot cover their shorts. And the problem is, just like with that idiot big shot in China, when the shorts can't cover their positions, and the shorts right now, we're not just talking speculators, right? There are speculators out there that are shorting, but we're also talking about producers, right? Farmers, miners, commodity companies who routinely short these commodities, not out of greed or price suppression, but as just normal day-to-day hedging as part of their business. They can't cover their shorts. And so what happens if they can't cover their shorts? Well, the bank that underwrote that deal, they're on the hook for the difference. And that's what JP Morgan was warning about. JP Morgan has started slowly warning. I referenced a couple of articles in that video that their head of global markets was sounding the alarm as early as the first week in March. And then yesterday with their report about how they were reviewing their commodities exposure. And again, when a big bank announces that they're reviewing something, it means they've already done it and it's a mess. And they're just trying to slowly ease us into the bad news that's coming. And what's going on here, all these commodities rising in tandem because of the inflation and now a problem that has been exacerbated by the Russian invasion. None of these commodity shorts are going to be able to cover, and the banks are on the hook for all of it. And they're already starting to talk about bailouts. You're already seeing energy traders and articles written. Javier Blas wrote an article in Bloomberg calling for central banks to shore up liquidity in the commodity space, saying they're too big to fail. They're using all this language that's eerily reminiscent of the global financial crisis, the early days of the pandemic. There's a mess brewing in commodities, folks. And you know what worries me the most as this mess is brewing right now? Because the banks are extending credit to all these shorts, right? The banks, so that the shorts don't have to cover, so that the squeeze doesn't happen, the banks are giving more and more credit to these companies that are short, to these producers and to these speculators. They're extending lines of credit to the shorts so the squeeze doesn't happen. Well, then that means that the banks are suppressing the price of all of it, of zinc, of copper, of aluminum. We know gold and silver, we've seen that, but not just that. Oil, natural gas, wheat, corn, all of it is being suppressed. And the bond market is starting to sniff out this problem. The bond market has been very quietly for the last month dumping the bonds of all these big commodity trading houses, dumping their debt, 85 cents on the dollar, taking a loss, because they see that they're not going to be able to cover their shorts. Well, what happens on Tuesday? Tuesday, we get the CPI report. The CPI report for March. Remember, all this big run in commodities, it all happened after the Russian invasion. And this CPI report is going to be historic. It's going to be massive. And what's going to happen when a historic CPI print hits? People are going to flood it. Longs are going to pile into commodities because that's what you do during inflation. You buy commodities to protect as an inflation hedge. Well, right now the banks and the commodity houses are doing their best to keep the prices of those commodities suppressed. What happens when longs start piling in? When every investor on the planet sees a historic CPI print and they say, I better hedge against inflation by going long commodities. And they start buying up ETFs and they start buying up commodity companies and they start buying up the actual futures themselves. And then a day after the CPI print comes out, right as this is happening, a day later, bank earnings start. And my theory is that the banks, when they report their earnings, they're probably going to report halfway decent quarters, maybe not terrible quarters, but every single one of them is going to warn about commodities exposure. And they're going to say our earnings next quarter are going to be terrible because of our counterparty risk in commodities. Or we're taking a one-time massive hit because we have to set aside reserves for losses in the commodity space. There's going to be some line item, some rider, some line attached in these conference calls from the banks about this commodities exposure. That's my theory anyway. That's what I see. And again, go check out that video. It's just article after article, headline after headline, one bank after another, one executive after another warning or theorizing about some problem attached to commodity traders, central banks paying attention, asking for bailouts, calling them too big to fail. And then I go and I look, interest rates on the rise, the MMMRI in extreme risk territory, right? It will not take that much bad news to pop this balloon because this balloon is ready to blow. So that's what's got me worried right now. And that's what that video was about. And that's why I'm saying banks plus CPI next week. Oh boy. That's what's got me really worried. All right. Let me real quick revisit the markets. We have got 21 minutes of trading left today. Silver is at 24.89. How did I get on the silver chart? Here we go. S&P down 4.5 points. Sideways day. The Dow is now up 181. Gave back some of those gains, up 0.5%. And the NASDAQ is down a little bit more now, down 160 or 1.15%. All righty. Here, one more thing about the financials. And I just wanted to point to this. I tweeted this out today. What we are looking at here is a chart of XLF. That is the financial sector spider ETF. Right? This is all the banks, all the investment banks, all the savings and loans, right? The big ones. Real quick, let I'll tell you what all the holdings are. It's all your big banks. But look what we've got brewing there. You guys see what that is forming right where I put the arrow? That is what looks like a death cross about to happen in the XLF. That's an ugly looking chart because death cross means if we get bad reports from a couple of banks next week, that'll be enough to complete that chart. And if you look back here, the banks have had one heck of a run going all the way back to the start of the pandemic. But this chart has just, I don't know. It looks like this chart has just broken down, doesn't it? With these 3 consecutive lows here. 1, 2, 3. Since really the end of last year. Banks seem to be in a downward channel with a death cross about to form. And now all this commodities counterparty risk. That might be what does it, folks. So I've got Mr. Mike Robin, Mr. Mike Binder again in the channel, and the super chats, and he is saying they're going to burr very soon, and as long as employment is high, they use their tools. Their tools are a sledgehammer. They're going to be so scared from the CPI read, says Mike Binder. Now, Mike, that's interesting. So your comment is kind of 2 different things here, right? If they're going to be scared from the CPI read, then they can't go burr. We all know they want to go burr again because that's like their default reaction to everything, right? It's like the trainer in my high school, Mr. Casino. No matter what you did, right? You'd be bleeding out the arm. You'd be like, ice it. I'll tape it up tomorrow. You have a broken leg. Ice it. I'll tape it up tomorrow. I sprained my ankle. Just ice it. I'll tape it up tomorrow. No matter what happened. Ice and tape. That was his response to everything. All right. That's the central bankers. Their response to everything? Print. Just print. They can't do that right now because the public is crying out for help in inflation. So they will eventually print, Mike. I strongly believe that will eventually be their move, but they can't do it yet because everybody's still crying about prices. So what they need to do is they need to create the conditions. They need to make things so bad. People's houses need to drop in value so much. Their retirements need to drop in value so much that they become more worried about their asset prices than they are worried about their fuel prices and their food prices. Right now, asset prices at all-time highs, they're more worried about the food and the fuel. We'll see if that holds true when the house goes down, when the 401k goes down. Are people less worried about inflation and now they want the Fed to start their burr again? I don't know. That's how I think it will go. But they won't start up burr again until everything breaks. And you've already got, I mean, they're talking here. And I mentioned in the video that the Fed the European Central Bank has so far declined any kind of liquidity injection to shore up these commodity traders. We saw a lot of energy companies in the UK went bankrupt in the fall when energy prices spiked. So right now they're letting these companies fail. If that turns into systemic risk for banks, however, they may not let them fail. That's when they go burr. But again, if prices are still on the rise, I don't think they can do that. It's going to be interesting. Thank you again. I really appreciate the super chat and the support of the channel. And I want to look here. The MMRI is now at 211. We're at 2.72 in the 10-year Treasury. That is higher than I ever thought we'd go. All right. I wanted to review a couple of things in the precious metal markets here because I saw some things I like in the charts in precious metals. But at the same time, we're kind of at a reflection. Is it reflection? Or an inflection. We're at an inflection point in the charts on some of the miners. And you can always look to the miners as confirmation of what the metals are going to do. If you see a big move in metals, but the miners don't play with it, that means metals are probably coming back down. Or if you see the miners run, usually means the metals are going to run soon too. Somebody sees something coming, and so they're buying the metals. So this is the silver chart here. Now, I've highlighted a couple of things. Make sure you guys can see. You can. Right here, circled in red, that's that golden cross. I love that golden cross. A couple of days ago, I guess a couple of weeks ago now, that is when the 50-day moving average went above the 200-day moving average. Very, very good technical sign. Now, we've come down since that golden cross, right? We've had a rough couple of days, couple of little price smashes here and there. But these last few days, I actually find very encouraging because what's happened, and I've circled all of these days, look at how every time we've come down to that 50-day moving average, we either bounced right off it or we dipped below and came above. Right? We've not closed below that 50-day moving average. And even just today, you can see the wick of that candle. It just touches the 50-day moving average today, and it's moved higher. All right, so that tells me that 50-day moving average, which is on the rise, is now a floor for us. It's acting as support. Very good sign. So even though we've been trading kind of sideways the last few days, that rising 50-day moving average acting as support is very encouraging to me. All right. Now, I see something similar in the miners. All right. Going back here, here's that golden cross again a couple of days ago. The same golden cross with the 50-day moving average breaking above the 200-day moving average. This is CIL-J, by the way. This is the Junior Miners ETF. I'm not looking at the CIL ETF because that includes a major holding in a Russian company, which is not touchable right now. Here's a nice bounce off of the 200-day moving average a couple of weeks ago. That's a good technical sign. All right. Now, here's another thing that we've got here. I drew this horizontal line here, and that goes all the way back, you see, to September. Not September. That's November of 2021, where that was our high then, and we failed to break above it, and we came back down. And if you see, we've kind of been bouncing around this level where we're at right now with the junior miners. And then here we are right below it, just trying to get above it. All right. I want to see a move above this line, and I want to see us stay there for a couple of days. Right? If we get a move above this line with any kind of volume and we stay above it for a couple of days, then that will tell me the miners are confirming that this 50-day moving average in silver is support. All right. So you want to look to the miners to reinforce what you're seeing in the base metal. And I got Mr. Cheeseburgers in the Super Chats. Thank you, Matt. I appreciate it very much. He says, collapse and then print, crisis after crisis after crisis. An economic collapse is as good as an excuse as any to inflate. Buy the dips with a question mark. Yeah, you know, that's been their model since the 80s, Matt, has been cause a crisis, print your way out of it. Or if not print your way out of it, cause a crisis and then lower rates out of it. Of course, they lowered rates all the way to zero, and that wasn't enough. So back in 2008, they started to print also. Right? Before 2008, they were just lowering rates with each corresponding crisis. They'd lower rates after the dot-com. They lowered rates after the bond market. They lowered rates after Black Monday. But then the global financial crisis, they lowered rates all the way to zero. It still wasn't enough. They had to do QE on top of that. And then now, in 2018, you had the Powell pivot. They started lowering rates to the point when the pandemic hit. Rates were already almost zero, so they couldn't lower rates anymore. They just had to massively print. And now here we are, one rate hike. We've had one rate hike, and it already looks like something's going to break in the system. I mean, you got Brainerd, Brain Dead, everybody. They're out there saying 50 basis point hikes, 11 hikes. Why not make it a baker's dozen? Why not make it 12 hikes this year? They're never going to make it there. 12, it's never going to happen. These projections are useless. You think I'm kidding? A year ago, what was the projection for rate hikes? A year ago, we were not even talking about ending the QE, and then the market, I think, was pricing in the possibility of one rate hike by the end of 2024. And look at where we've come in 1 year. Now we're talking about a dozen rate hikes. It's never going to happen. These projections are useless. All right? They're worthless projections. Honestly, I'm not sure at this point we're even going to get to that 50 basis point hike in May. We might. We might not. I don't know. I mean, just looking at the 10-year where we're at right now, above that trend line, you throw 50 basis points onto that, forget it. Instantly breaking. Instantly. Just my opinion. That's what I see when I look at the charts. Again, there's smarter people who look at the charts than me, and they draw different conclusions. So challenge what you hear from me, folks. Don't just take what I say at face value, but that's what I see when I look at those charts. And thank you, Matt. I appreciate the support of the channel, buddy. What else does he say? Buy the dips. Be careful what you buy on the dips. I have my eye on commodity plays, on mining stocks, on energy stocks. All right, but I'm going to play it by ear. Don't just rush in and buy because you see a 500-point down day. That's all I could say, because this could be the big one that gets so bad that we finally learn our lesson and change our ways and decide we're going to return to sound money, and we're not going to just embrace modern monetary theory and we're finally going to recognize that Keynesian economics is a failure, hey, a guy could dream, right? Leave me with my fantasy. That's what, maybe that'll happen. And if that happens, buying the dip will be a failed strategy because we're looking at massive deflation if that were to happen. And you don't want to hold stocks during deflation. So that's possible. Anyways, thank you. I appreciate that support of the channel. And Dumb Money Media, thank you again, sir, for your support of the channel. The King of Money says, I went in super deep on my UVXY play for next week. I ain't selling unless I get a 40% plus, barf, laugh, barf. I like UVXY, Dumb Money Media. I actually bought calls in the VIX itself. I was on the fence about buying UVXY or buying the VIX calls themselves. I could still go either way, to be honest with you. I've been working a lot with Devin Brines. Shout out to Devin. I seen you in the chat there, brother. He's been helping me out a lot with doing some of the math, and he's been teaching me Greeks and things like that because I'm actually not that good a trader when it comes to option strategies. I try to be upfront with my own limitations here, guys. But I bought these calls in the VIX, and I almost bought more today. If the VIX dips below 20 next week, on Monday, I am going to buy more VIX calls because I think the bad news hits the tape on Tuesday. And I bought some more VIX calls. I doubled my position last Friday, but I didn't make any other trades this week. I may add on Monday if the market gives me an opportunity. So good luck with that play, Your Majesty, the King of Money. I hope that works out for you, brother. And thank you again for your support of the channel. Steve Woitis, thank you for your super chat, sir. I appreciate it very much. He says, what is the average time from interest rate hikes until consumers stop spending? Is it 6 months? I don't know that there actually is any real correlation, to be honest with you, between consumer spending and rate hikes. Certainly, I mean, wow, did you see that number that came out? Thank you again, Steve, for the support of the channel. Did you see that number that came out yesterday? Where is it? I had the headline open. Here we go. Consumer debt in the U.S. surges by a record $40 billion. All right, Americans right now are putting life on the credit card. $40 billion. I think the expectation was like $8 billion of consumer credit they were expecting, and they got $40 billion. What's the worst thing that could happen? Put another $20 billion on the credit cards, America. We're good for it, right? We can only warn. We can try to warn them, right? I can sound the alarm. I can say this isn't going to end well until I'm red in the face. I can say it week after week after week. Got to live within your means. You got to be reasonable. But people don't want to hear it, and they just want to put it. I don't know what they're thinking, especially credit cards. It's adjustable rate debt. All right, the interest rate on your credit card is going to go up with rate hikes. What are these people thinking? I don't know, but it's not going to end well. That is a very bad sign. And, well, eventually this has to hit. What's going on right now is because inflation is going higher, people's ends are not meeting, and so they're maxing out the credit cards. They're not changing their spending habits. They're not buying less expensive phones. They're not taking fewer vacations, at least not yet. It's going to happen eventually. Eventually this credit will dry up. So thank you, Steve. I appreciate the super chat, brother. I appreciate the support of the channel. Matt is here again. Hello, Cheeseburger. Again, pretty sure the goal is hyperinflation, which will completely break your country into pieces, which has been the stated goal of some dark influence. My throat's getting dry from talking so much. Thanks again, Cheese, Matt, for your support of the channel. And yes, I do think, sadly, hyperinflation is the goal. It's the only possible way that the government can ever hope to address the federal government's debt. There is no way humanly possible to pay back $30 trillion. It's just not possible. We can't even stop the growth of the deficit. We can't even stop spending more than we have, let alone shrink it, let alone ever get that debt pile back to zero. There is no hope of that ever happening. Anybody who proposes it gets laughed out of D.C. Why? For being reasonable. For being the only non-clown in the circus tent, right? They literally laughed at Ron Paul when he ran for president. He was laughed off the stage at the GOP debates. History will view Ron Paul favorably, the people who laughed at him not so much. So I think the plan is to inflate away the debt. If you cannot possibly pay it back, why not just devalue the dollar that it's measured in? And then once $30 trillion is the price of a loaf of bread, then you pay back your $30 trillion debt. And you say, see, I kept my word. I gave you back all $30 trillion that I borrowed. Never mind the fact that $30 trillion is no longer worth a loaf of bread, but we paid back our debt. That's how they're going to pay it back, which is a default, right? They're defaulting on their debt. They're just doing it in a sleazy way by paying back worthless currency. And yes, I think that's where this goes. Because, look, if we get deflation, forget it, then the value of that debt gets even bigger, and the cost to service it gets even bigger. It's the only possible outcome here. The numbers are now so big, there is no other possible way short of an actual default, where we just say we can't pay it, so we're wiping it out, we're going bankrupt. And that brings all kinds of mayhem with it. But again, that ends in deflation. So I don't think they're going to do that. Anyways, thank you guys. I really appreciate all these super chats and all the support of the channel. Really helps a lot. All right, now we were talking about the miners and silver, and I would be remiss if I did not mention gold. And here we are looking at the charts, and I see the same thing playing out in gold. All right. I have this line up here. I drew this a couple of months ago or a couple of weeks ago. Got to move my melon, make sure you guys can see. Here we go. I drew this line a couple of weeks ago. This is the all-time highs, right, that we just broke above and then failed. But zooming in here, again, we've got the 50-day moving average acting as support. And as the 50-day rises, the price of gold, the floor under gold, is slowly rising with it. All right, and then I look at the gold junior miners. Same thing we saw with silver, right? We are now retesting this high from back in November. We've got that golden cross, and we've got the 50-day moving average rising. So I want to see a move above this previous November high. I want to see us stay there for a while with some decent volume before the miners can confirm the move in gold. We get the same thing in GDX. This is the regular gold miners ETF. And you got the same thing. There's that golden cross. There's that November high that we're now just struggling to recapture. And I want to see us move above that. And then the miners have confirmed the move in the underlying metal. And who was it? Was it Matt? Was it Cheeseburger that asked before to talk about Russia's central bank? Here it was in gold. This came out yesterday. Russia's central bank says it will stop buying gold at the fixed price. And this was I did a video about this, was it last week or 2 weeks ago, that Russia had put a floor under the price of gold with their 5,000 ruble per gram standing bid on gold. And I had said that was going to break the COMEX, because now as the ruble rose in value, because the ruble was now tied to oil and gas also, that was going to cause gold to flee the COMEX for Russia, where they can get more money for it. Well, the Russians realized they're now paying too much for gold versus the COMEX price, and yesterday they very abruptly canceled that standing bid. They're no longer going to be buying gold for 5,000 rubles per gram. And here, just going to read a little bit from here. Russia's central bank said on Thursday that due to a significant change in market conditions, i.e. the ruble is now higher, it would buy gold from commercial banks at a negotiated price from April 8th. So this goes into effect right away. On March 25th, the bank had said that it would buy gold at a fixed price of 5,000 rubles a gram until June 30th. So the Russians have gone back on that offer. They're now saying we're going to buy it at market price. So much for that floor in the price of gold, courtesy of Vladimir Putin. Looks like they have backed off on that offer. All right. So another trade I've been following a lot here on the channel has been energy. And here I just wanted to say XLE, that is the one trade I made this week, was I sold half of my remaining calls in XLE. This is the energy sector ETF. I still have calls for, was it June or July? I can't remember. I have calls that are still out there a couple of months. But my May calls were coming up a little close. I don't want to hold them into the last month where the theta decay is going to eat me up. So I sold half of my remaining. I still have a little bit of this one left. And since it's going to run, and just zooming in on this chart here, Can you see? You can. I'm looking here, and we have broken above our previous high, and we've still got this ascending level of support. So even though oil has come down, stock market is not buying it because the oil stocks continue to rise. And that's because the only reason oil is down right now is because, like I said at the beginning of the stream, the banks are suppressing the price of all commodities, and President Brandon is suppressing the price of oil by draining our strategic petroleum reserve. Which, by the way, if we're being marched off to war by our fearless leaders right now, after spending a month watching Russian tanks run out of gas and get towed away by Ukrainian tractors, maybe draining your military's fuel reserve is not the smartest decision to make. Maybe we should worry a little bit less about short-term poll numbers and a little bit more about the long-term positioning and strength of the country. I just throw them out there. You guys do what you want with them. I just throw them out there. But everybody knows draining the strategic petroleum reserve to suppress the price of oil is a Band-Aid solution. You will eventually run out of that reserve, and then all you've done is, through price suppression, prevented any new supply from coming online. God, we wouldn't want to produce any more energy, right? Again, I just throw them out there. Produce energy, what? What kind of crazy conspiracy theory extremist idea is that? Produce more energy. Shut this down. Shut it all down. Everybody go home. We're done here. I'm too extremist for YouTube. I say maybe producing more energy is the right decision. But what do I know? I'm just a guy on YouTube. So XLE, the energy stocks, they're going higher. They're going to keep going higher even though oil is down. And real quick, I had the oil chart up. Where is the oil chart? Here we go. We are in this downward channel in oil that we have been in since the start of March. But again, I think this downward channel, that is the lid that's been put on us by the banks and by the releases from the Strategic Petroleum Reserve. We do have a floor under us right here in the high 90s. I don't think we go that much lower than that. I really don't. I don't see any scenario. And again, folks, I just want to say, I've mentioned it a couple times, if the Iranians get involved in this geopolitical fustercluck, if the Iranians get involved in that, then this chart is going to disappear at the bottom of the page because oil will go so high, so fast, we will wonder why we didn't pile in the 90s. And, hey, as long as the Iranians stay out, maybe this $100 mark will hold. But I just don't see them sitting this one out. I really don't. So we're going to keep an eye on oil prices as we go. And I see Lady Eris, thank you very much for your support of the channel, for your super chat. I appreciate that. Thank you, everybody, for the super chats. I appreciate that, guys. And speaking of energy, while we're on the subject, I have to mention LNG, Cheniere Energy. This is one I've been long for a while now. We're still in that upward channel, so this trend is alive. We're about mid-band. If I see us get near this lower end of the line, I'll buy more. If I see us get near this higher end of the line, I will sell some, but I'm just trading around my core position. As long as we remain in this channel, I'm going to let most of that ride. And last but not least, I have got the corn trade here, and I don't even have any lines on this chart. All I know is corn is going higher, folks. Corn's going higher because they're going to be growing less of it this year. 4 million fewer acres will be planted in the U.S. You saw that video I did a couple days about this. So we're going higher. And my corn options, my January 2023 calls are up like 150 some odd % right now and still climbing. So I have yet to take any profits in my corn trade. This one's going a lot higher for a lot longer. So that's that. I just got a message from my dad. I have been watching. I'm trying to warn my dad about the bank stocks. Hey, Dad. Thanks for watching. Hey, look, there's people smarter than me have been saying the banks, right? And, you know, I'm just this perma bear. I'm just this perma bear who said everything was going to break at 2.2 on the 10-year, and here we are at 2.7 and nothing is broken. So, you know, I've been wrong before, folks. It could happen again. And real quick, I just want to play this one. Shout out to Jim and Ivan over at Wall Street Silver who posted this one. Unfortunately, I'm going to mute my mic here, folks. We're seeing this kind of stuff. Get used to this. This is going to get more common. That is food riots breaking out in Sri Lanka, folks. And unfortunately, I think scenes like this are going to become so common in the next year, year and a half, that we're going to get desensitized to it. I really think it's going to be so common that it's not even going to register on our bandwidth anymore when it happens. Again, the food shortage, the food preparation, folks, if there's one thing you take away from these streams, let it be that. Get yourself prepared, get your family prepared, because this is happening. I mean, we've been talking about it for months on this channel. There's now 2 countries, Peru and Sri Lanka, where this is happening. Food prices are higher than they have ever been globally, and they're still going much, much higher. Remember, this fertilizer story has not even started to show up in food prices yet. It hasn't even started. We've already got food riots. And lastly, I have to tell you guys, remember to enjoy the good times, because the hard times are coming, but they're not here yet. So don't waste these good times. Enjoy the most of it. Have an awesome weekend. Spend time with your loved ones and your family. Hold them tight. Spend some time with your kids. And I am going to build the chicken run this weekend that I didn't get finished. My dad is coming over. He's going to help me put it together. The girls are going to help. And last but not least, it is 4:06. The markets are now closed. Let's do one last visit. The S&P closed down about 12 points, or 0.25%. The Dow closed up 137, or 0.4%. And the NASDAQ closed down 186, or 1.3%. All right, guys. With that, I think we are going to call this one. I want to thank you guys so much. Oh, did I miss somebody? I missed Cheeseburger in the Super Chats. He said, too late to buy corn, you think. Cheeseburger, is it too late? No. It's late. It's definitely late. I'm already up 150% in my first corn options that I bought. But it was about 2 weeks ago I bought even more. And that USDA report just came out last week. And again, the fertilizer story has not even yet hit. So I don't think it's too late on corn, but it is late. I don't know if it's too late. All right, when you're buying something that's already up 150%, it smells a little FOMO-y. All right, but I am still holding, and I'm still holding because I think they're going higher. So take that for what you will. And thank you again so much for your support of the channel, Matt. I really appreciate it. Guys, I appreciate everything, your comments, your feedback, your emails, your messages on Twitter, your retweets, your comments on the videos. Thank you so much. Big shout out to my Patreon supporters, all you guys who support me there. Thank you very much. There is a link down in the description of this video of that as well. Don't forget, check out that video I did in more detail about the situation with the banks and the counterparty risk in commodities. I had a couple people say there was a lot of information in that video and I talked really fast. So watch it 2 or 3 times if you want to. It's great for the algorithm. Really helps me out. And if you want to slow down and read it nice and slow and check out all the links that I referenced to it, again, there is a link to that companion article that I wrote on Brian Zarb's website. So you can check that one out. And while you're there, subscribe to Brian's newsletter. Brian is a fantastic technical chartist. I have the privilege of interfacing with him on the regular now. He's always sending me charts and ideas. He's been on the channel a couple of times, and his last few calls on precious metals have been right on the money. So check out Brian's newsletter while you're there. It is free, and it is awesome. All right, guys, it is that time. I want you melonheads to have a fantastic weekend. Again, enjoy these good times while they are still good. Prepare for the bad times, but enjoy the good times. And until next one, live small and dream big.